What up, guys? It's January 2nd, and Happy New Year to everybody. Okay, I've been out of this game for a little bit about posting things on YouTube and on Instagram, but we're back full blast. I took pretty much most of Q4 off to kind of just get a break from all this, YouTube and social media and everything, which can get pretty crazy sometimes. But we're back, full business, full blast. So enough of that. Okay, let's talk about the markets. That's what we're good at. That's what you guys are here to get the lowdown on what's going on. Okay, so let's get on with it. All right, so we got today, Tuesday markets, January 3rd, 2023. Market is closed. This is why I have the little pre-market disclaimer here, the little pre-market logo. Market's closed today in observance of New Year's Day. They'll be back full on tomorrow, back to regular business, okay? The vacation season essentially over, okay? So we start here with the Dow Jones, 33.1, S&P 38.39. Interesting thing, S&P's had a rough time trying to take down that 3,800 level. Pretty interesting because I think it should have easily taken down that 3,800 level on the S&P. It's had a rough time doing it in this December. So we'll see. It'd be interesting to see what happens there in January. And we'll talk about the S&P a little bit more closer later when we're talking about more of the buying strategies that we're implementing around the S&P, okay? Got NASDAQ at 10.4, a little bit recovered from that 10,000 level that it hit a couple weeks ago when it got hammered really good. Russell 2000 right here, and the VIX at 21, pretty low as far as volatility there. And that's mainly probably because most of Wall Street was on vacation during December. So we did get some sell-offs, some kind of very moderate sell-offs towards the end of December. That's because Wall Street's just not there. Not all of Wall Street, but we'll see that now. And maybe that'll change that now that tax loss selling or tax loss harvesting is done for the end of the year. And you can ask me what that is. If you don't know, send me a message or comment. I'll let you know what tax loss harvesting is, okay? Now, when it comes to bond rates, the last video we did about 3-4 months ago here, 3.35 was the 10-year bond yield, 3.84, so going towards 4. You guys know that if this goes, the higher it goes, the more that these high valuation stocks just get murdered, right? Look at Tesla, guys. Stock that was selling at a multiple of like 100 times forward earnings, like 12 months earnings. Now it's selling at 27, 28 forward earnings. I mean, completely demolished. And this has a lot to do with it. Also the recession, the economic outlook, that's too. But this is an indicator what these high valuation stocks are going to do. And these stocks that get price to sales ratios instead of price to earnings ratios get really obliterated when these go up. Okay. Now we have energy. Oil down from last time, 85, right? Brent down again. So the whole energy complex, natural gas, pretty much taken down almost 50% on natural gas. That's good for Europeans. I'm sure Europeans are happy to hear about that. So good stuff on the energy front. I'm sure that the energy companies, the energy stocks are feeling it a little bit when their prices get slashed and their dividends suffer a little bit when all these prices get hit, okay? Now, we want to focus on the usual, right? It's kind of boring, the Federal Reserve and inflation, but that's what's driving the narrative. There's nothing else that drives the narrative at this point. Everything else that you know about the world and about what's going on, about the economy, it's already priced into the market here, guys, right? The market knows the same as you do, if not more, probably more. And it's already priced all that in this action here, okay? Now, of course, market volatility, December, very volatile. No Santa Claus rally. We got a Grinch rally or Grinch bear market, if you want to call it. Okay. And then in other news, we got the F-150 Lightning. Okay. We got it in late November, so we've had it a little bit over 30 days sitting there in my garage. Excellent vehicle. My wife picked it up here. There she is, my lovely wife Nubia, picking up the truck per se. I took it today to the mountains. Phenomenal vehicle. Very powerful. This truck has no business being that powerful at all, okay? I know I've taken people on rides and they're all impressed. Very happy with it. As a Ford shareholder, amazing. As a regular person, driver, incredible. I'm not towing anything, so if you're asking about towing, all this stuff, I don't tow nothing. So I don't care about towing. Other than that, it's fantastic. Very happy with it, okay? And of course, CES this week, okay? Wednesday, Thursday, Friday, I'll be posting from CES on Instagram. You can follow me there and all my stories. I'll post them there as far as everything we see that's new on the floor of the Consumer Electronics Show. If you guys want anything different other than, the stories and the posts online, let me know if you want a video or something. I kind of feel like videos and stuff too long, and most people don't watch those. I feel like just something very simple, that kind of summarizes what you're seeing and what it is and how cool it is is perfect, and Instagram gives you a perfect, perfect opportunity to show that stuff to you guys. So if you guys want different, let me know. Okay, now moving on. We're also going to talk about our new position, which is Smart Rent, symbol SMRT. Okay, this is our smallest, newest position in our portfolio. Again, we haven't sold a share of anything. Okay, we've only been buyers of stocks in this bear market. Only been buyers because we are using the opportunities the market gives us to increase our positions and make the best of it. So when these interest rates start to go down and the Fed starts, moving around in the opposite direction, we're the beneficiaries of that, and we don't go, oh, we should have bought when things were bad, and So we've done our job this year, or this past year. We're gonna be on the lookout for this year, and we'll start with the Federal Reserve. So we all know the Federal Reserve still not our friend, right? So the Fed fund rate's currently sitting at about 4.25 to 4.5, right? And they're always talked about, the Fed fund rates, but also people forget about quantitative tightening, what it's called QT, not cutie, like, hey, you a cutie, QT, quantitative tightening, okay? So 95 billion per month so far that the Federal Reserve is taking out of the market, taking out of the economy and liquidity by selling their bonds, right? So this is less than expected, believe it or not, right? But what people are saying, and what I hear a lot of economists saying, is if you take a 4.5 Fed funds rate, just a normal funds rate, and you factor in the current QT, the rate is closer to 5% already, or 5.1 on the actual Fed funds rate. So it's quite elevated already. So the expectation of the market, of course, is maybe one or two more rate hikes this year in February and March, and then a pause, right? Which is what we're talking about, a pause or a pivot, right? Pivot meaning, hey, now we're no longer raising rates. We're going to go down and actually, lower the rates, which would be great, right? But of course, we're talking about demand destruction and what happens with inflation. Okay, so if you've heard the last speech by the Federal Reserve, right, the funniest thing that you take from this is this quote right here: the worst pain comes from inflation being entrenched in the economy, right? So they're causing demand destruction, right? Everybody who follows the market, the Fed, the overall the economy has to know that the Federal Reserve is trying to create demand destruction, right? All they can do is take a big hammer to the economy, to consumer demand, and raise rates and do their quantitative tightening, right? This is why it's harder to buy a house, right? This is why your credit cards, the interest rate is higher. This is why buying a car is much harder nowadays, because of that interest rate. The Federal Reserve is actively trying to get you not to buy things on purpose so they reach price stability. So, of course, everybody who follows me should know this already. If not, I hope that you learn this. If you're in the market and you don't know this, this is imperative. This is pretty much the whole ball game right here, okay? Now, the market reaction currently of all these good or bad news is good news is bad and bad news is bad, okay? So we'll break that down. So good news is bad because it brings this guy on to hammer us even higher with higher for longer, right? So unemployment being good, right? Like unemployment staying lower, it brings on Jerome Powell to hit the economy higher for longer, right? Good economic data means this guy comes and gets us higher for longer. So that's why good news is bad. But bad news is also bad because the bad economic data means that we're slowing down and earnings are going to suffer. So it means that these multiples for these stocks will get hit and earnings are going to just crash, right? Or slow down significantly at the very least. So I know this sounds very official, but I want to bring up something I saw here on Instagram, which is kind of funny. This lady on Instagram, which I believe she's an economist, really funny, very smart. Obviously, she brought up the perfect explanation in the form of a reel on Instagram, and I want to show it to you guys because this is the best explanation I've heard about the Federal Reserve and their way of thinking and what they're doing to the economy. So let's look at this real quick. Check this out.
You might have heard that we want you to be unemployed, and that's sort of true.
What?
Stop buying stuff right now.
But I have to live.
This is your world now.
But I need a job.
Your job is reducing services inflation, and that is
What about price gouging or lack of production? or any other supply side inflationary issues.
All we can do is just restrict.
5% rate in 2025.
When will you stop?
Look, we know you want a house or to retire, but hey, inflation.
But how will you know?
It's scientific. Guys like this, inflation. Guys like this, straight up inflation.
This is the product of 0% rates.
So, what's this mean?
Not knowable. The worst pain
comes from inflation being entrenched in the economy.
You might.
So there it is. Right? There she is. And if you want to follow her, Kyla Scan is her name. Very smart. I listen to her podcast from time to time. Very much recommended. Nobody's paying me for this. It's just somebody I recommend because I've seen her stuff. Very interesting. Very on point, as you guys can see. Okay, so let me bring this to the side. Now, in this reel, she talked about these things. Higher unemployment, right? So, yeah, the Fed wants higher unemployment. They want you to lose your job. Yes, they do, because they want wage inflation to be under control. And they're going to hit everything with a hammer until this happens, right? We need an unemployment rate of about 5% in order for this guy to calm the heck down, okay? Now, she talked about services inflation. Essentially, this is something that higher interest rates cost, right? They cause the opposite of service inflation. So they're saying, hey, stop buying things, right? Like the lady saying on the reel, right? Stop buying things. But then the guy goes, what about price gouging or lack of production, supply side inflationary issues? The Federal Reserve can't really help those things, right? If there's a shortage of tomatoes, why would the Federal Reserve raise rates so you don't buy as many tomatoes? You still need the tomatoes, right? So there's so many things that they can't do by just using a sledgehammer to the economy. And they're, it just doesn't make any sense, right? So supply side inflationary issues, I mean, how can they fix that other than demand destruction, right? And of course, the restrict. That's all they can do, right? And what does this mean? Not knowable. It's actually quite head on, because if you listen to their speeches, essentially they do a lot of that. Well, we don't know what these data points mean, and we look backwards, not forward. So we really don't know what we're doing, and it's right on the money. So very well done from this Kyla Scan lady. Very well done. Okay, now when we're talking about inflation, of course, the main thing we're looking at is CPI, guys. Right? This is it. I think January 12th is the next time that CPI comes out for December. And we're seeing that CPI on a month-over-month basis has very much been under control. And also on a year-to-date basis, very much on a downward trail, right? We see inflation peaked in June, and it hasn't looked back since, and it's been on the right trajectory. So undeniable that inflation is going the right way. Now, a little bit more about inflation here. Fundstrat, if you guys know Fundstrat, that's that Tom Lee guy that comes out on CNBC, who's like this permanent bullish analyst that always says, hey, things are going higher every single time, right? Be careful with these guys, right? Even if they're so positive. But I wanted to bring this presentation by Fundstrat, because I was looking at it and I thought, hey, there's things here that make a lot of sense when it comes to inflation, right? Let me put it in red here. So they're saying 2022 is now shifted into opportunities, creating the highest probabilities for greater than 10% returns since 2020. Of course, 2020 is when the pandemic hit, right? And then we couldn't, everybody thought the stock market was going to die, and the opposite happened because the Federal Reserve became extremely accommodative to the economy, and everybody made a ton of money from all this liquidity being pumped into the system, okay? So contrary to those arguing for sticky inflation is falling like a rock, evidenced by near halt in inflation in October and November CPI, Consumer Price Index. And he's talking about core and services, but minus the shelter costs, which is something that Fundstrat is watching very closely. Cost of shelter, when those start going down, it means pretty much the fight is over, according to them, okay? So likely repeated December to March, meaning, hey, it's going to continue to slide, but we have to watch the shelter inflation costs, okay? That's something more specific that we could talk about another time, okay? Now, Fed framework very likely to change sharply in 2023. Inflation is tracking lower and lead to fewer hikes in 2023 and a lower terminal rate. Bond market sees this evidenced by 2-year yields now below Fed funds post-December FOMC, right? That's FOMC is the meeting of the Federal Reserve. He's saying this is historically a pause for the Federal Reserve. So remember, pause or pivot. Which one is it? The kind of prevailing sentiment is two more rate hikes, and then a pause for the rest of the year. No lower rates or no lowering of rates until end of 2023 or beginning of 2024. Who knows, right? Who knows? If anybody, any of those guys had a magic ball, right, or a crystal ball, they'd be billionaires, trillionaires by now. They're not. Okay. Now, he talks about the soft landing narrative. If you guys remember, the soft landing narrative was the Fed is going to raise rates, the economy is going to be able to take it, and then once inflation is under control, the economy is still going to be strong or relatively, moderately strong, that we can take back off from that point off and land softly and take right back off. That's the narrative. That's what they're thinking is the highest probability moving forward, okay? Rare back-to-back negative equity years. Very true. When the markets have such a bad year, it is extremely rare to have negative back-to-back years, okay? But at the end of the day, who knows, guys, right? Who knows? Equities 22% positive average gain post a negative high yield return year. So that's what he's talking about. This is what it is. So it's history on our side. Apparently, we don't count on that. Of course, we don't put on all our chips on black just because they're saying that that's what it is. But very interesting to hear that. Okay, tailwinds exist for EPS in 2023 due to weaker U.S. dollar. Price of the dollar, very important, right? So when we see the dollar moving higher, it's more expensive for companies to repatriate their profits that they do overseas when the dollar is strong, right? So if you remember, guys, Palantir said, hey, I wish I could show you an extra 20% revenue growth. I can't, because the profits we're making overseas are costing us a lot more to repatriate because of the strong dollar. So when the dollar backs off, that's when it's easier for them to do. So I agree. That's a tailwind for sure. Tailwind, again, is something positive. Headwind is something negative. That would be the opposite of tailwind, okay? P likely to expand as 10-year at 3.5 to 4.5 historically leads to PE of 18.5 to 19.5. Now we're talking about PE ratios. When you think about price to earnings ratios, he's talking about historical price to earnings ratios. Again, I'm not too much of a fan of price to earnings, the current price to earnings ratio. I'm a fan of forward price to earnings ratio based on the company's, future revenue prospects. Okay, so not going to talk too much about that. And our top three sectors are technology, right? That's the worst performer. Energy, the best performer of 2022, and industrials in the middle of that, okay? So they're downgrading Staples, UW from N. I don't know what that means. So very positive outlook by Fundstrat on the economy, okay? Of course, the opposite argument of the bears is exactly the opposite of this, right? Sticky inflation, fund rates higher for longer. The Federal Reserve is going to break something as they're raising rates. They're going to break the housing market, which is going to break this and break this and break this. And it brings us into a bad recession. That would be the opposite argument of this. Now, let me tell you guys about this. This is I showed this slide last time we talked about 3-4 months ago. And it's kind of funny because it's essentially what's happened so far and what I think will happen still. And I think it's very important. Bill Ackman, very famous investor in the market. This is the guy that when the pandemic hit, he was like, oh, take all your money out. This is it. This is the end of the world. He got it completely wrong, and the markets went straight up right after this guy talked, essentially, right? For like a year, maybe even 2 after this guy talked, just went straight up after he scared the bejesus out of a lot of people, okay? But doesn't mean that he's getting this one wrong, right? So said, this is from September 6th. So that's what I'm telling you guys, September 6th. He's saying investors are waiting for the Federal Reserve to halt its rate hikes before they aggressively move back into the stock market. And he said, I think once people realize the Fed doesn't have to keep increasing rates and will soon be taking rates down. Remember, there's a big span of time between, keep increasing and taking rates down. What is the time frame of those two things, right? And that's kind of a buy signal for the markets, okay? Better to be too soon than too late, right? And that's my opinion. You make your own decision, but better to be sooner than later on that time frame, okay? And we've done that. We prepared our portfolio for that, okay? He's saying investors will likely anticipate this when they see a powerful continuing trend of moderating inflation. This is already happening, right? Already happening. For this part, the fund manager predicted that the Fed still needs to raise rates and likely hold them at elevated levels for around a year to tamp down inflation. Here it is. There's that time frame, guys, right? And what they've said they're going to do, they have to do, which is to raise rates to something in the order of 4%, or maybe a little bit more. Remember that slide we talked about? We're there. We're already there, okay? Keep them there for a reasonably extended period of time, maybe a year or so, right? Prevailing market sentiment. Now, looking out a year or so, Ackman predicted that inflation would be at around 3.5 to 4% with a downward trend, okay? And now when we're talking about this guy, that's what he's saying. Fundstrat now is saying this is a lot sooner, right? This is happening somewhere in February or March. These are going to be the inflation rates in February or March. Now, this is a moderate type of analyst, right? And Wall Street, persona, and Fundstrat is saying, no, this is happening a lot sooner because of the data we're getting. Now, you have to make up your own decision as to who is right here or who is closer to being right, or take a middle ground approach and think that this is going to happen somewhere around June, right, of next year, and plan accordingly, okay? Now, mostly holds the same investments at the beginning of the year, now counting short-dated alliance with Netflix. Whatever, okay? Now, there we have two very kind of similar but not exactly the same, right, sort of approaches to what's going to happen in 2023. But if you take that narrative, you can plan around that narrative and know what you're going to do. So if I bring up a chart here of the S&P 500, our plan has been pretty much the same here, right? And I'm not going to pay for that thing. No way I'm not going to pay for that. And we're going to see here that our buy levels are going to be right around here, guys. This is where we're buying the market, okay, with the S&P 500 being at these levels. If we look here, the lowest level it's been here, it's about 38.51 or 35. Right here, what is this? 35.80, somewhere around there. It's been the lowest level of the S&P this year. And we're looking at the S&P because it has the last bastion of defense from the bears, right? So the bears have attacked the market this year. Very obvious from this chart that the bears have attacked the market on a very negative trend the whole year. This is a 1-year chart, right? We've chosen specific spots of the year to do some buying here. And we've done it successfully so far. It doesn't mean that we're up on the year. We're still our portfolio is still not doing well like many other portfolios out there, but we have time on our side, right? We're patient. We know when to pick our battles and when to actually deploy capital in these two spots here in the market, right? So if you take the S&P, you have the FANG stocks: Facebook, Apple, Amazon, Tesla. Well, Tesla's not FANG, but the big S&P 500 stocks. Those are the last stocks to actually get demolished, the last ones. So we're using the S&P as an indicator of when to buy any stock that we want to buy to get the actual best price of the market that the market can give us. Okay, so hopefully here the market does something like this, right, and then goes right back up, or does something, let's see here, maybe something like not like this. That's definitely not what we want to see. But if it does break that level, it'll be pretty interesting to see, because now the next level resistance is about 3,300 as far as the next level resistance, and that's when we would be buyers if it breaks this level. Okay, now enough about this technical stuff. I don't like talking about it anyways. Let's go with the last thing, which is our newest stock in the portfolio, SmartRent. This is our smallest position. This is something we started somewhere around November, December. We started this position. Again, still building it. It is the right valuation for me at about $2.30. Right now it's about $2.42. So we're a little bit above our cost basis. Who cares? I think under $2.50 a share, I'm a buyer any day of the week. This is a great business with a huge total addressable market. You see here, enterprise software, and they control every aspect of apartment complexes and real estate industry when it comes to making smart apartments, smart businesses, right, and administrative control. It's also listed as a Morgan Stanley top deflators for 2023. Very good balance sheet, completely debt-free, and you're buying it for about maybe $560 billion when they have about $216 million in the bank. And I said billion, no. So let me say that again. The valuation is about $530 million right now in the stock market. Million, not billion, million. And they have almost half of that in cash on their balance sheet with no debt. Growing revenues, huge total addressable market, tons of a huge book of business, for now that they have currently, that they have recurring revenue for, and a huge book of business that is oncoming, even more than twice the amount of the business that they have coming from the future. So very excited about this business. I'd definitely gladly be building this position the next 6 months to a year, depending on what it does. Okay, and you guys can see here self-guided tours, building access control, video, community, smart apartments, smart parking. And they're selling the software. So we have recurring revenue, which is the best kind of revenue you can have. Wall Street loves recurring revenue, kind of like that subscription type revenue. That's what recurring is. So very excited about this one. So I don't want to talk about it too much. I'm going to do an own dedicated video about SmartRent later when they report their earnings for Q4 of 2022. And that'll be it for today. So again, guys, thanks for your attention. I definitely appreciate you guys sticking with me. I hope 2023 is a much better year. 2022, that's the best news we have, is that 2022 is over. It's behind us. Time to focus on the new year. Let me know what you think on the comments below. Hit me up on Twitter, on Instagram. I'll drop all the links below. Peace out.